Late night, they ain't getting no rest. Work so hard, people think I'm obsessed. Cream at the crop, won't settle for no less. Headed to the top, arena so focused. Yeah, gorilla of the jungle, I've been beating on my chest. I learned from the struggle, it was all just a test.
Hey guys, welcome back. So today I want to talk about the Bitcoin market cycles and how I look to enter and exit, kind of the trend. So I've had a few questions just talking about what I look to buy into the market. So when I talk about the confirmation on the high time frame, I'm going to get into that, as well as talk about some of the warning signs that I looked at, similar to prior cycle peaks, that gave me that signal to de-risk and be out of the, not out of the market, but really rebuild my cash position, get rid of any kind of risky plays, and then really mitigate that risk, realize profits, and then position myself to be able to take better advantage of any potential opportunities going forward. So we're going to jump into the charts over here. We'll take a look at the Bitcoin risk. The current here is just under 0.5, so we're at 0.493 at 84,500 for Bitcoin. That is down a little bit just because we are actually at 85 now. We're getting a little bit of a pump. So Bitcoin, at that 0.5 mid-risk territory, might not really a bad place to be DCAing that 0.5 risk. That being said, if we are in a bear market or going into a bear market, just recognize that we're likely to continue to lower levels. We generally see that 0.4 down to 0.2 risk as a more common bear market territory. So we could be looking for a potential, if you start DCAing based on risk from that 65,400 mark down to 37,000, we can see the color-coded risk. We are still just at that under 0.5. So and then our time in the risk band. So we're in this 0.4 to 0.5 risk band. So in terms of how much time we spend in these, 0.3 to 0.5 is where we spend the most of our time for Bitcoin. That just means, so what we see in the Bitcoin chart, essentially, if we look at the monthly to get a good idea, we see we have just these long periods of consolidation and then these really short explosive bull markets. So we see here explosive bull market, but in between we have these long consolidation phases. So what we do get as a result is kind of more time in the risk of these lower risk bands, these 0.3 to 0.5. Because the majority of Bitcoin's time is really spent kind of consolidating, where the actual bull market moves are really compressed and short time frame. So if you're not in the position kind of by the time that bull market really takes off, then a lot of the time you kind of have missed some of the opportunities to buy really cheap. Basically seeing here though that we're just in that mid risk level. So you might be DCAing, but you're gonna maybe just be saving a bit more capital for the lower risk level, aiming for that 0.4 and lower. If we take a look at the Bitcoin chart here on the monthly, so I like to look at multiple time frames when I'm trying to get a good idea of the cycle perspective. Not just looking at the daily chart or just the weekly or just the monthly. You need to look at all of them together. They're going to tell you different things, and then you need to be able to take all that information and come up with an opinion for yourself. So what we saw here on the monthly is basically, we saw this major extension of the MAC or of the RSI on this cycle, another major extension in through this cycle, and the same thing we saw here, a major extension, and you kind of see that it's just diminishing returns each time. So if we draw a trend line from here, you can see getting a little bit less oversold with every subsequent cycle. That just kind of means as the asset is growing in price and kind of growing in size, it's not as volatile just because of that growth and that stability as more liquidity comes into it. We can also see though the MACD, one major extension on each cycle, and then we see right here, as soon as that blue line has gotten above the red line here, that's the signal that the bear market lows are in and the bull market is kind of starting to kick off. And that's what we had over here. Bear market lows in, bull market kicked off. So you can see basically very similar monthly indicator setup to all the prior cycles for now. And then, yeah, that parabolic SAR flipping negative on the monthly. So that's these dots right through here. You can see every single time it flipped, it either either coincided with a bear market here, or in this case, that was a 55% mid-cycle correction, just based on how the momentum indicators look relative to the other peaks. You know, I don't necessarily think that we're going to have another third leg up to a higher high. You know, I could be proven wrong, and I'd be happy to be proven wrong because I still have a lot of exposure to Bitcoin and kind of related proxies. So I'm happy to be proven wrong. That being said, based on the historic technical setup, it looked weak. It's looked weak since about 100,000. That's when roughly we de-risked. So kept Bitcoin, kept my core miners, kept a little bit of Ethereum, sold my altcoins, sold my meme coins, sold leverage positions, and sold any options plays on proxies. You know, anything highly volatile and highly risky, I de-risked, got rid of it, booked profits, or just kind of got out of those positions to mitigate that risk. And then you see what has happened since. We've dropped 20-30% from the highs to these lows. So that was definitely a good play. And now we're starting to see all that weakness in broad markets and kind of general uncertainty in the macro side of things, really supporting that risk off narrative. So I'm really happy with that decision to de-risk there, book those profits. And now I'm better capitalized to take advantage of this retracement here. Not only can I buy more, I have a better cost basis. So really good to pay attention to that. Don't ignore certain time frames. Make sure you're looking at multiple ones to get the best idea of what's going on. Looking here at the weekly time frame as well. Same thing that we saw. I'll show you here. We have our bull market structure. So that's that price is above the 50-day, which is this orange line, and that's above this 200-day moving average. So price above 50-day, above the 200-day. We had an initial extension, we had a sweep underneath the moving averages, and then we had a secondary extension. We got ultimately rejected at a slightly higher high. We lost our 50-day and our 200-day moving average. We retested it, got rejected, came back into this bear flag consolidation into the 50-day moving average where we rejected again and then continued lower. So this is kind of what I'm looking at right now. We have our initial extension of the price over the 50-day, over the 200-day. We had our initial sweep underneath these moving averages. We put in our high and a secondary kind of slightly higher high, but almost more of a double top scenario. We saw that 50-day moving average starting to curl over, and then we also saw the bull market support band here. So that is another thing. We saw that starting to be lost as support. So major moving averages that kind of signal our macro uptrends started to lose structure. We lost our 50-day, we retested it here, we got rejected, and we're currently retesting the 200-day moving average here. If something plays out like it did over here, where we get that 200-day and it kind of breaks above, we might get something like this, where the 200-day comes up and then the 50-day goes like this, and then we see price action go up into that new 200-day. But ultimately, if it plays out like the move over there, then we could just reject and be due for that downwards price action. So that's what we see over here. We had that initial rejection by the 50-day, and then we had this secondary attempt right in through there into the 200-day rejection. So that's what I'd be looking for right there as another confirmed kind of data point that could signal we're due for that broader bear market correction. Essentially, though, that hasn't played out yet. It doesn't have to play out. We just follow the price action. If something changes, then we change our stance and we're ready to enter the market whenever it makes technical sense to do so. Right now, it doesn't. So we're in this bear market consolidation. We returned to our previous cycle 786 Fibonacci. So that is basically a good level to expect a bounce. We can see we were in downtrending price action right here. I'll zoom in. You can see it's kind of harder to see on when it's not zoomed in on a higher time frame, but basically right here we put in that higher low, that higher high, and then that subsequent higher low. We had a bullish cross of our 50 and 200-day moving average. We're above that 50-day and that 200-day moving average, holding it as support. And then if you look at our momentum indicators, we're nice and reset, coming from that deep oversold bear market territory, and we're starting to gain bullish momentum here here on our trend-based indicators. So that signals to me we could be potentially reversing the trend. You're looking to enter that position here. You're not going to put all of your money in on a single purchase. That's just too risky in my opinion. So then we see, once we enter here, maybe entering half of your ideal position, stop loss below the prior lows, protecting you from getting wicked out of that. And then we wait for price to continue up, hopefully following along our thesis. We see here that we're continuing to hold these as support, and then we can look for that additional confirmation over here. We're starting to continue with that uptrending price action. So holding here, you can look for an additional entry, stop loss again below these lows, looking to add more here, and then riding that up as we're kind of in the uptrend. So the really hard thing to do all in through here, you could be DCAing Bitcoin based on risk all through this level here. Sorry, just something like this. If you're DCAing based on risk in this range here, that's really good. You still end up with that kind of rough cost basis similar to these entries here. So when we get to these low kind of risk levels after a substantial drawdown in kind of after that bull market, don't really hesitate to be DCAing based on risk. I like to do a combination of kind of everything. So I'll DCA based on risk as well. I'm going to save a substantial amount of money for the actual technical confirmation. So let's say I have 50% cash right now in my portfolio, and I'm looking to kind of enter that throughout the market in kind of this bear market opportunity. Then maybe I take 20% of that kind of overall cash and I use it to dynamically DCA based on risk, and then I wait for the technical confirmation of uptrends, and then right here I'm going to put a larger lump sum of money into the market. I get more technical confirmation, I put an additional larger lump sum of money into the market. I now have a nice adjusted cost basis all throughout this range. I'm happy with that. I didn't take too much risk, and then I'm also making sure that the trend is on my side and then riding it from there. From there, if you have additional capital left over from that cash position, or you have income that gives you kind of that steady amount of capital, look to take advantage of the bull market corrections. So right through here, we saw a 22% correction. Right over here, we saw about a 30% correction, 33% correction. And then these actually offered good buying opportunities. So we saw here, we had our correction, but we broke back above. We held that 50-day moving average as support. You can look to take a swing position here, adding that. And then same thing that we saw over here, we had this down sloping trend line. There's two trades here that I saw. Basically, we switched from downtrending price action to uptrending. So here is the downtrend, lower highs, lower lows, and then right here we reversed our price action to that higher low, higher high, higher low. That's confirmation right there. You can enter a position here, and then you've got that in addition to these buys. We see our breakout move here, back testing that support and bouncing. That's an additional swing position entry. So look at all these different technical opportunities to buy into the market, each offering really good returns. The major ones being our accumulation ranges down here, offering anywhere from 420 to 350%. If you are DCAing based on risk, getting some of these lower targets, you're looking at more of a 5 to 7x move. So really with the bulk of our money, we're getting between a 3 to 5x return in a really short amount of time. So I'm more than happy with that. I don't need to perfectly time top or bottom to make really good gains and compound them, and it's much less risky. So again, never going to time top or bottom perfectly. If I do, even with partial amounts of my position, I'm really happy. All I really care about in the long run is compounded returns. That's all that matters. Consistent returns, compound returns. That's how you're going to build wealth over a long period of time. And then just coming up with a system like this removes that emotion, removes the kind of risk of buying in that downtrend all the way down. That's the biggest mistake I made my first cycle, was I timed it really well. I got out, I made profits, but I reinvested way too early. So if I was just patient, if I just learned the things I did before, look at the similarities technically to the other prior cycles, waited for things to come back to those levels, waited for that technical confirmation of the uptrend, I would have been able to accumulate 3 to 5 times as much Bitcoin as I initially ended up with after my first cycle. So that's been a big lesson to me. It's something I always keep in the back of my mind. That's why I really hammer on the kind of the points of managing your emotion, managing your patience, and then not FOMOing. So again, that comes with the emotion. Come up with that strategy that helps you remove that emotion. For me, it was learning technical analysis. You know, again, I'm not here to time tops or bottoms. You know, that's how you're going to buy a falling knife. That's how you're going to FOMO in. That's not how we're going to make nice, consistent returns on a long period of time. So we saw that here this cycle. So basically what I'm going to look at now is why we saw that was in these other prior cycles. We saw a kind of similar thing happen where we had our bull market here. We lost that bull market structure. We broke below our key moving averages, that 5200 day, and then you see we're stuck below it all the way down to here, and then that is where our price action started to reverse. So we got our higher low, our higher high, subsequent higher low. We get our initial entry here. You know, we got that 50-day moving average curling up. We came from deep oversold territory on our MACD and our RSI. You can see right through there. We are gaining bullish momentum on our trend indicators. So that signals to me, you know, likely we could be due for a potential reversal, entering initially here. And then we get that bullish cross of the 5200-day moving average, additional confirmation, and entering an additional larger buy there as well. And then you see where we have that stop loss that actually protected you from this drop here. This was the COVID crash, so impossible really to predict that substantial of a drop in such a short amount of time. But you see, by having that stop loss there, we protected the position and we held on to it, and we were able to capitalize and hold on for the remainder of the bull market here. And you see basically coming up, and then again when I talk about multiple opportunities to enter the market, guys. So here they're all different risk. You know, we entered a little bit here, we entered here. This is another opportunity to enter here because you see we got back above that 50 and 200-day moving average with uptrending price action. So that again just signals to me that the uptrend is likely to continue. You got another position here, and then same thing here. That's that bull market corrections that I talk about taking advantage of. We see here probably a 30% correction or something. Yeah, 30%, and you know, another opportunity to buy there. And same thing here, another 30%. So yeah, there's really a ton of opportunities. And then same thing we saw here, the structure of the market kind of risked a little bit here. Oversold. So you pay attention to those indicators. We saw we came back. We know we got a little relief rally here. I wouldn't enter this position until we actually held these lows. And then you see on our indicators we reset. So pretty much resetting our momentum indicators could get that other leg up. Stop loss below the lows, holding that, and then we see getting that leg up with the uptrending structure for the secondary extension here. And then ultimately breaking down, consolidating sideways between the 200-day and the 50-day, getting rejected by the 50-day again, breaking below both, getting rejected by the 200-day, and then that's the bear market. So that's what we're watching for here. We saw in that cycle, and same in the 2017 cycle, the price returned to at least the 786 Fibonacci, which is kind of where it ended up consolidating, finding its lows. So if we see something like that play out this cycle, we're looking anywhere from $36,000 Bitcoin up. Even, you know, the 618 might act as a little bit more of support this cycle just due to the increased institutional demand and adoption and kind of the diminishing returns, diminishing losses theory. So potentially look to accumulate Bitcoin between 51,700 and down to about 36,000 here in this Fibonacci golden zone. Otherwise, look to use a combination of the Bitcoin risk, dynamic DCAing here. So when we get to 0.4 and lower, look to use that dynamic DCA and then really build your cash position. So the way you can do that, you can do it from income if you're a trader and you take profits on short-term trades. You know, maybe you just save money elsewhere. Really look to build your cash position during the downtrend while you're still simultaneously DCAing, ideally based on risk. That's going to be the best option, I think, in my opinion. And then when you see that technical confirmation, this is where you're going to enter your sidelined cash position. This all the way down here and sideways, that's for DCAing, and then having a cash position to go in hard when the trend reverses to the upside and capitalize on that move, realize those profits. You don't have to time the bottom or the top. I personally, I was only fully invested in the mid 20s by the time I was comfortable with that confirmation, and I took a lot of profits up, just around 100,000. So I didn't nail the bottom, I didn't nail the top, but I hit about a 4x move, which, 4x on any substantial amount of money, you shouldn't, it's not to scoff at, that's really good returns. You're not making 4x your money in the stock market in kind of a 2-3 year basis. That's just never going to happen. So don't kind of fade the idea of taking profits. Don't be greedy, and then just follow the same system. When we get technical confirmation that a downtrend is about to start, we're looking for ways we can exit our positions or de-risk the things we don't want to hold in that downtrend. And then same thing, when we start to get to these lows, we're looking for that technical confirmation to tell us when it makes sense to put all that money back into the market and ride it to the upside. So I hope you guys learned something new. I just wanted to break down kind of how I like to treat these markets. It's complicated for sure, but as soon as we come up with a system that works for us, that's what's going to help remove that emotion and then really help compound those returns. So for me personally, dynamic DCAing based on risk during downtrends, or a scheduled DCA, and then saving a cash position for that technical bottom accumulation after that confirmed trend reversal. So that's pretty much how I do it and how I like to enter the markets. It gives me a good adjusted cost basis. It stops me from entering all of my money at a certain position, taking excessive risk at any specific price. Spread those buys out, spread your risk, and then wait for the returns to come to you and take your profits off the table as they come. Everyone's strategies and goals are different. Your price targets might be different than someone else's. Don't let someone else's opinions change your strategy, because we're all different at the end of the day, and we're all going to kind of have different goals and different strategies. So thank you so much for watching, guys, and I'll see you in the next one.